such as major highs, major lows, or important supply and demand zones. Catching these sweeps gives us a huge edge because it shows where the market has just collected liquidity and is likely to shift direction. The core idea behind identifying liquidity sweeps in our daily bias is simple. When sell-side liquidity is cleared out through a sweep, the price often moves towards buy-side liquidity, and vice versa. This understanding helps us predict the next likely move of the market, especially when we're analyzing the 30-minute, 1-hour, and 15-minute time frames. The second reason they're so important is that they add extra confirmation to our trades. Here's the logic. The market needs liquidity to build momentum. If price doesn't sweep liquidity before reaching a key level, it often uses that area to gather the liquidity it needs for the next major move. For example, look at this case. The price swept the buy-side liquidity above this major high with a strong green candle. But notice, the very next candle quickly closed back below the range. So what does that tell us? It signals that since the buy-side liquidity has already been taken, the price is now likely to move lower towards sell-side liquidity sitting below. If this behavior aligns with the overall market direction, it can give us a high-probability selling opportunity. Even if it doesn't match the dominant trend, a liquidity sweep can still suggest a potential reversal, even if only temporary. Now, after completing all these key steps on the analysis time frame, you should have a solid understanding of the overall market sentiment and a clear idea of what price is more likely to do next. If everything looks perfect, meaning you've identified a high-quality setup that aligns with your trading plan, and both your micro and macro timeframes are in agreement, then it's time to move to the next step. At this stage, we start searching for an entry point. This is where the entry timeframes, like the 5-minute or 1-minute charts, come into play. Here, you zoom in even closer to look for confirmation signals and finally execute your trade. The main reason we zoom into the lower timeframes for execution is simple. It gives us a clearer view of the price action and offers a higher risk-to-reward ratio when we take positions on the micro timeframes. Now, first things first. After zooming into the entry time frame, you need to wait for the price to tap into your analysis time frame's area of interest and show signs of rejection. Once you see rejection, the next step is to look for a market structure shift or a change of character. After a market structure shift is confirmed, the next move is to identify a PD array. This could be a fair value gap, an order block, a breaker block, or a mitigation block. Which one you focus on?
Unlock your trading potential with our free daily gold signals on Telegram. Join a community of like-minded traders. Share insights and stay motivated every day. Make smarter decisions, stay inspired, and take your trading to the next level.
And will depend on your trading model and personal preference. And finally, after identifying the PD array on the entry time frame, we can use it to open a position and execute our order. Additionally, the entry time frames can be used to add extra confluence and confirmation to our trading setup, helping to increase its probability of success. You can also strengthen your setup by looking for VSR patterns or using tools like the volume profile or the fixed range volume indicator on the entry time frame. Now, here on the Euro-Dollar 1-hour time frame, we have an unmitigated bearish order block created by the bearish market structure shifts move, presenting an ideal area to look for short opportunities if the price taps into it and shows rejection. At this point, I zoom into a lower time frame, typically the 5-minute chart, to closely monitor the price action and watch for signs of a market structure shift. With the 5-minute chart on the screen, the next step is to patiently wait for the price to form both a market structure shift and a 5-minute PD array. Once these conditions are met, we can look for an entry to go short from the 5-minute PD array. Now, we can see that price has created a market structure shift by breaking and closing below this swing low. This indicates that buying momentum is fading and sellers are once again taking control. Now, our bias shifts to bearish on the 5-minute chart, and we can confidently look for short opportunities. Also, we can see that price has created a breaker block, represented by these down close candles. The price formed a swing high, then a swing low, followed by a higher high, before immediately reversing and breaking below the down-close candles. So we have our 5-minute PD array that we were looking for, so we can set a sell limit at its lowest point, aiming for the next clean swing low as our profit target. This shows how truly combining multi-time frame analysis with a clear roadmap on the chart can lead to well-informed trades and simplify the way you approach trading. That's it, traders.